Hi everyone, today also let's do another past paper question from the area NPV. Today we are going to discuss 2015 accounting paper 2 question number 7 part A. So for a 400 mark question, this particular question will count for like 10 marks. Let's go through the requirement first, then we'll read the scenario, then we'll get into the answer. Requirement number 1, what they are asking, initial total cash initial. So that is very important. Initial total cash outflow showing that each item included separately. So they are asking us to show each and every item separately, which will come to the year 0 initial. So this is year 0. Annual cash inflows and outflows from year 1 to 4. And they're asking us to calculate the net present value and finally the recommendation. Now let's go through the scenario that they have given. A company is planning to start a printing press. The cash flows associated with the purchase of the printing machine required for this purpose are as follows. So they have given the values in thousands. So we'll do the calculation also in thousands. So these are the values that these are the amounts that we are going to spend if we purchase this particular machine. Purchase price of the machine is 2000, site preparation expense is 200, installation charges 300. So what you have to understand, all these are going to be cash outflows for the year 0. Cash outflows, because for the purchase we have to spend money. To prepare the site we have to spend money. To install the machine we have to spend money. So that's why it is cash outflow. That's why I wrote the years inside the brackets. Expected residual value and the useful life of the machine 500,000 and 4 years. So we are planning to sell the asset after 4 years for 500,000 residual value, scrap value. For 4 years we can use the asset, after that we can sell it. Then if we sell it after 4 years, we will get that money because we are selling the asset after 4 years. So if we sell the asset, we will get money. So this is a cash inflow for the year 4. Working capital required at the beginning of the project 500,000 and it will be recovered at the end of the project. So with regarding the working capital, there are two adjustments. One is, this is something that we have to pump in. Our money is going out in year 0. For the working capital purpose, we have to give money. If not, they will not be able to run the project. And end of the project, we can recover it back. So another adjustment is there. In year number 4, we can recover it back. So year 0 outflow, year 4 inflow for us. Expected income and operating expenses of the printing press are as follows. So they have given the income and expenses. This is something very important. These amounts are included in the depreciation. 2000, 3000, 3500, 4000. Inside these expenses, depreciation is included. So you know, when you are doing an NPV calculation, you can't have any non-cash items like depreciations. So from these values, do remember, from these values, we have to remove. We have to remove the depreciation. So I'll write it and keep. When we are doing the calculation, then we can remove it accordingly. And they have given the discounting factors. Now we'll go to the question. Question number 7, part A of that part 1. First, we have to show the initial cash outflow showing each item included separately. So we'll write it: purchase price, site preparation, installation charges. Purchase price, site preparation and installation charges. Installation charges, what are the values? 2000, 200, 300. So I'll do the calculation in rupees thousands. 2000, 200 and 300. And we are not done. because we have to take everything, initial cash outflow, each item. Here for the working capital purpose, so this is done, this is done, this is done. For the working capital purpose, we have to have an outflow of 500,000 working capital. Working capital. Then what's the total amount for the year 0? 2,200, 2,500 and 3,000. 3,000. So this is the total initial means year 0 outflow. So we are done with the first part. Now let's move to the second part. Second part, what they are asking, annual cash inflows and outflows from year 1 to 4. Year 1 to 4. So let's do it over here. Year 1, year 2, year 3 and year 4. You have to take the cash inflows and cash outflows. So I'll write here cash inflows and I'll leave like few lines and I'll write the cash outflows. So this income is going to be my cash inflows. Income. What are the values? 3,500, 4,500, 3,500, 4,500, then 6,000 and 7,500. 6,000 and 7,500. So we are done with this. Don't miss anything, huh? Do everything properly. And here residual value year 4 or scrap value year 4, how much is that? 500,000. Residual value of the asset, we can sell the asset after 4 years and we can get that 500,000. Residual value 500,000. So we are done with that turn as well. Next one. And with regarding this 500,000, year 0 outflow we considered. Year 4 we can recover it back. So working capital recovery. Working capital recovery. Working capital recovery. We can recover that working capital as well. 500. So that is also done. Now we have to get the operating expenses. So operating expenses, from these values we have to remove the depreciation. Then how to calculate the depreciation? Your cost of the asset minus the scrap value divided by the useful life. So here what you have to understand, cost of the asset is addition of these three. 2,000 plus 200 plus 300. That means 2,500. Minus the scrap value is 500. Useful life of the asset is 4 years. Then 2000 divided by 4, 500. This is the depreciation per annum. Depreciation per annum, that means for a year. That means from each of these values we have to remove 500 and only we have to take the answer, because inside these values depreciations are included. So here from 2000 if you remove 500, 1,500. So those are cash operating expenses. Cash operating expenses. Why did I use the word cash operating expenses? Because this operating expense 2000 has the depreciation. So once you remove the depreciation, you are getting the cash operating expense. 1,500. Then 2,500. 2,500, then 3,000 and 3,500. Remove 500 from each. 3,000 and 3,500. 3,500. Done. So now let's take the total inflows. Your outflows, you have only one. So directly we can take the net cash flow. Net cash flow. Here 3,500, 4,500, 6,000, 8,500. Then what are the net cash flows? Inflows minus outflows. Here it is 2,000. Here it is 2,000. Here it is 3,000. Here it is 5,000. So we are done with that one as well. Part 2. In part 3, what are they asking? They are asking us to calculate the NPV. Part 3 of the question. So let's calculate the NPV. How to calculate the NPV? Year 0, year 1, year 2, year 3, year 4. You have to multiply your net cash flows from the discounting factor. In this question, 10%. Then you will get your present values. So net cash flows year 0, we found it earlier itself. 3,000 year 0, here we found it 3,000. Outflow 3,000 negative. Then here 2,000, 2,000, 3,000 and 5,000. Now let's multiply from the discounting factors. Always year 0 discounting factor is 1. Here 0.9, 0.8, 0.7 and 0.6. So let's confirm the numbers. 9876. Yes. Now let's get the present values. Here negative 3,000. Here 1,800. Here 1,600. Here 2,100. Here 3,000. Now let's take the NPV. So here you have a negative value. These are positive values. So let's take the addition of the positive 1,800 plus 1,600 plus 2,100 plus 3,000 minus 3,000. So I am getting a value of 5,500 plus. So what is this? This is your net present value. Your net present value. If not 5.5 million. Since we did it in the thousands, your answer was 5,500. Real number is 5,500. And fourth one, they are asking us to write the recommendation. Fourth one, they are asking us to write the recommendation. So you can write the recommendation since the NPV is positive, it is recommended to proceed with the investment. It is recommended to proceed with the investment. So a simple question. In this question, if you ask me what is the tricky part, the tricky part is this one. Inside these values, depreciation is included. So you have to remove the depreciation and only you have to do the calculation. And apart from this, when you are calculating the depreciation per annum, you have to take all these three additions. So very simple question. Easily you can get this 10 mark if you have studied properly. So this is not only the NPV question that I have done from the past papers. I have done the NPV question in other past papers also. You will get the playlist somewhere over here. So you can click and watch those past paper answers as well.